Welcome to, is this on? Yeah. Welcome to the Lamb and Rock seminar. This semester, Steve and I are teaching a seminar together, and unlike Michael Wachter seminar with Leo Strine, where they work really hard pulling the materials together and making the students write really hard, long papers and so forth, we decided we were going to do it in a much more selfish way. We decided that we would use this as an opportunity to get people we know to come and teach us about what's going on in the world so that we can figure out what's going on in the world, what the issues are. And for today's session, we decided to open it up to a larger community, a larger group, because of course the question of shareholder activism is a very important question more generally. So today our guests are Mark Weingarten from Schulte Roth. Mark, I think, is without overstating the case, I think Mark is the leading hedge fund lawyer in the country. He represents them all, near as I can tell. There may be a few who have slipped out of his grasp that he hasn't managed, but he represents Cerberus, he represents Jana Partners, he represents TCI, the Children's Investment Fund, a wonderfully sweet name for a hedge fund that has shown a capacity to play hardball. He has represented Pershing Square. He's represented the whole lot. Before he got into the business of representing hedge funds, he was at Georgetown Law School, and before that was at the Wharton School of the University of Pennsylvania. So we can claim at least a piece of Mark as an alum. Our second guest today is Dan Pedrotti, who's director of the AFL-CIO Office of Investment, and so is one of the leading figures in union shareholder activism. Dan is also JD from Wake Forest, BA in political science from Dickinson, and before joining the AFL-CIO in 2004, Dan worked in various firms in Philadelphia and DC. Together we have really two faces, I don't know if it's the only two faces, but two faces of shareholder activism, the hedge funds and the unions. Between them, they are among the most active shareholders in the country. And the hope today is to explore in a fairly informal way the dynamics of shareholder activism. We're going to start with Mark talking for a bit about what he and his clients do, and then we'll turn it over to Dan. Then there'll be, along the way, I imagine, Vice Chancellor Lamb and I will interrupt and ask questions. And then we'll open it up to general discussion among the panel and with you guys. So with that, let me turn it over to Mark. Thank you.
Thanks. I guess you wanted to hear about what the goals of activism are and what the techniques are that they use, just as an introduction. And I'll refer to activists, although my clients and yours and their peers are very different. I don't know if we call ourselves financial activists and institutional activists, but I'll just refer to my guys as activists. It's a very singular explanation for what they're after. They're looking to make a profit. They're not looking at green investments. They're not looking at just doing right for the sake of doing right. They're looking at making money. They only make money if the other shareholders in the company that they invest in also make money. Those other shareholders make money only if the stock price goes up or if they otherwise get value for their stock in excess of where the stock sat before the activist showed up. That happens only if the activist can move the company to take action which enhances shareholder value. So that what it's all about is, from the activist viewpoint, fundamentally maximizing shareholder value. Their conduct, by the self-interest of making money, should result in companies that they're investing in acting more responsibly, acting more efficiently, acting more profitably. If they don't, their stock won't get up, the activists won't make money, and the strategy really fails. So Hopefully, I think, both sorts of activists end up looking for the same thing. I would say we're just a little more direct about it. As far as how activism works, many of you are probably already familiar with it, but the activist playbook is pretty standard and straightforward and relatively uniform. Step one is deep for the responsible activists, deep research about the company that they're about to invest in. I represented TCI last year when they waged a proxy contest against CSX. They had spent a year investigating the railroad industry, every company, every major railroad in the railroad industry, the legislative environment for the railroad industry, macro trends, at millions of dollars of expense hiring consultants in the railroad industry and economists before they bought a single share of stock of any railroad company. They went on and invested in several. Just for a little bit of a war story, they met with the managements of almost every major railroad company in the country except CSX, who refused to meet with them, and were convinced that the others were either already doing the right thing or were going to. CSX, which wouldn't talk to them, they were convinced it was the worst performer in the railroad industry. Hadn't done terribly, but it was surely the worst performer, and they were convinced was not going to do the right thing. Therein lied the profit opportunity. When I remember I was in Washington at a congressional hearing that was instigated by CSX about the hedge fund investment in the railroad industry, and one of the congresswomen said, well, why are you going after CSX? Why don't you go after one of the other ones? And he had a hard time explaining to her that it was because it was the worst performer, and that's why he loved the stock. Anyway, it is the profit motive that motivates these guys. After they've done their research, the next step is to buy a toehold position in the target company. Often they buy long securities, sometimes they buy on swap, but they get invested. And frankly, it's one of the advantages of the strategy is that they can invest before they announce their intention to take action against the company, and therefore before the stock goes up. That's how they profit as well. They then almost uniformly, I can think of rare exceptions, approach the company privately to discuss their ideas as to what they think the company ought to be doing to become more profitable or to get the stock price up. They do it not particularly because they're nice guys, but it's much more efficient, much quicker, much cheaper if they can accomplish their goals on a privately negotiated basis and have the company just listen to their ideas and adopt them. That is the ideal and done, as I say, uniformly. If they're rejected or the company refuses to meet them, as many do, they'll typically go public with their interest. They'll break 5%, file a 13D, go public with what their views are, what they think the company's shortcomings have been, what they think the company ought to be doing. They'll talk to other shareholders to get their support and to get them into the stock in some cases, in order to try to pressure the company to coming around to their viewpoint, and particularly to get other shareholders to support them so the company gets the sense that what's being proposed is something that most of the shareholders would like to see happen. If they're continue to be rejected, the last and final step is proxy contest. First the threat and then the actuality of it. Unfortunately, I think for many companies, it's a step that unless the activist is willing to take, he'll make no progress. For many boards, certainly I think many companies, mid-cap and small cap, I think certainly less true at large cap companies that have better qualified, more responsive boards. But at many companies, they are deathly allergic to having an outsider in the boardroom. And it is the proxy contest and the threat that those outsiders are going to go into the boardroom that ultimately moves them off the dime, and I think persuades them that many of the shareholders support this view and want this action taken. Many proxy contests settle more than go to term, but that's really what their goals are and how they achieve them.
Dan?
Thank you.
Same business or different business?
Same business, maybe a different time horizon, a different orientation, which we can talk about. But just to give folks a sense of how we approach this, why is labor involved in shareholder activism and corporate governance? I guess we have to start with our funds, right? Our members' deferred wages. And just in terms of scale, we're talking about $6 trillion, right? And this is pre-market meltdown, so it's probably 4 now. And how does that break out? There's about $500 billion of what we call union-sponsored funds, and those are jointly held funds that have both equal parts labor trustees and management trustees, and that our members can take with them from employer to employer. So in the construction industry, in the entertainment industry, they're multi-employer funds. So that's the union-sponsored funds. Obviously, a much wider universe of assets are public funds, right? The CalPERS of the world, New York State Common, and that's almost $3 trillion. And then you have the single-employer funds, the Verizons and IBMs and Exxons, that some of which are collectively bargained, some of which are not. So we're talking about deferred wages that have a time horizon that's generational, and that are broadly diversified across the market. So in so many of these debates, when we're talking about shaking up governance at a company, the CNBC chatting head will say, why don't you just sell the stock and leave, do the Wall Street walk? And our response is, well, we can't, right? We're broadly diversified, and why would we sell the stock versus working with the company to improve their governance and generating better long-term value? So our program is really geared around working with the stewards of worker capital, and those would be both trustees and the staff at the funds, to make sure that the benefit funds themselves are secure, that they're sustainable long-term returns, and that their deferred wages are invested in value-creating ventures. And I would argue, we're understanding this better now, that too many of our members' retirement funds were invested in speculative transactions instead of value-creating ventures in the real economy. And we can talk more about that. So just a few framing comments. The first is shareholder activism, right? There's no natural rights of ownership here. This is all a creature of public policy. This is all politically mediated. And I think what we're starting to emphasize more and more is the need for greater rights for long-term holders, and embedding that idea, that core value in initiatives like Proxy Access, better disclosure of the interest of short-term investors, and other ideas which we can talk about. But I think it's worth looking back historically, pre-1980, if you will, and since 1980, and that sort of helps inform the answer to the question: what kind of governance structures do we want at public companies? What are the ones that we see as most valuable in terms of what we're after? So pre-1980, obviously, you had an externalized structure of real governance. You had companies that were constrained by outside forces, obviously the government through tax, regulation, an SEC that actually did its job, public opinion, and stronger unions. Since 1980, I think we fundamentally shifted to a structure and a regime in which executives answer instead to short-term markets, short-term incentives, and that obviously turned out to be pretty bad. Of course, after Enron, we tried to build a different structure, both in terms of rewriting some of the rules around accounting and stronger boards, but that was, again, undermined by the short-term crowd in part. So obviously at this moment, we need to do something different, and it starts for us with stronger boards and asking who their constituency should be. So let me give you a sense then quickly of just what are some of the current issues that we see in shareholder activism, what's the day-to-day work that we're engaged in. And it's really in 4 areas, I would say. One is shareholder power, second is CEO pay, something which of course you probably never heard about. Third is board accountability, and fourth is healthcare of all areas. So with shareholder power, obviously there's 2 big items. First is equal access to the proxy, which the new SEC chairwoman has said they'll take up in haste, and I think that's an important initiative, because one thing that we've seen over and over again is long-term shareholders like our funds lack the tools to hold boards accountable. So the debate around equal access to the proxy, opening up board elections, shaking the dead boards up is going to matter a lot, and also it's going to be of tremendous importance. What are the ownership thresholds in order for funds to be able to get access to the proxy, and how long will they hold? There'll be a lot told in those two metrics. Second is obviously vote no initiatives, some of which you began to see last year at banks that had limited success. We should have been much broader in our efforts, but I think you'll see more time and effort spent in that area in the proxy season ahead. So that's shareholder power. CEO pay. That would include, you heard the debate, I'm sure, around say on pay. I think it's almost a foregone conclusion that will pass. My new favorite pay excess is something called golden coffins, which, being as we're in Philadelphia, my favorite example is Comcast, where Mr. Roberts, if he were to die in office, his heirs are entitled to about $200 million in payouts from the company's coffers, from shareholders. So I'm used to, in the labor movement, to being called outdated all the time. In this case, we are outdated because one of our critiques of CEO pay is that it's pay for pulse. Well, of course, this is pay for no pulse. So golden coffins are one area we're focused on. But more importantly, clawbacks, reform around compensation consultants. There'll be an interesting article, I hope, in tomorrow's New York Times about my favorite comp consultant, John Typhoid Mary England from Towers Perrin, who was the consultant for Angela Mozilla when we all thought he was working for the board. So keep an eye out for that. But those are sort of the core areas of reform. And at the very end, maybe return to pay in the Wall Street context and talk a little bit more about what kind of activism we're involved in. Board accountability, obviously of tremendous importance. When we were having discussions with a number of the banks last year, one of the things that stood out to me in frightening detail was the lack of risk management on the part of these boards, was the lack of a number of these board members, audit committee chairs, lead directors, knew there was something going wrong. They just didn't know how to ask the right question, which is pretty disturbing. So board accountability and going forward in terms of prescriptive reforms, the need for an independent chair, the need for greater independence is going to be a theme you'll be hearing a lot about. On healthcare, why are we focused on healthcare? You may have seen in some of the materials that we made available before this, the SEC under Chris Cox of all people and their Corp Fin department made a reversal last year in allowing proposals about healthcare on the proxy, on the company ballot. That was obviously a big battle, but I think the reason that's changed is informed by a story that was told to me by an official at an industry group. This is a group of Fortune 100 companies, HR executives there, and we were down. President Sweeney from the AFL was giving a speech to them about the need for common ground around healthcare and the need for reform. And the staffer for this industry group said, it's fascinating. We put out a survey of our members that we can contrast with 15 years ago when we were debating healthcare again, and fully a third of our members now favor single-payer healthcare, which I found staggering. But what is it in our proposal that we're pushing on and asking companies to adopt? It's asking them to adopt the principles around the Institute of Medicine that healthcare should be universal, continuous, affordable to individuals and families, should enhance the health and well-being of society and enhance the health and well-being of society through high-quality care. And we have all kinds of facts we point to in proposals that say healthcare is the number one competitive concern of companies. And we're seeing this when we introduce a proposal to a company in terms of companies' willingness to adopt a proposal, willingness to define themselves and put themselves on record as being in favor of reform and basic principles around reform. So 17 companies in total so far, but included in them American Express, GE, IBM, Peabody Energy, Starbucks, United Technologies, and Verizon. So a pretty wide range of different companies from different industries. Let me just say one more word about pay, and then we can get more into where Mark and I may agree and agree to differ. And then I hope at some point we can talk about re-regulation, because as we were discussing before we came over here, there's a huge debate going on now about what should the architecture of the financial markets look like. There was obviously a failing in both enforcement but also jurisdiction. And you're seeing all kinds of ideas being generated now. I think the president is going to have some kind of template ready in time for the G20 meetings in a few months. But how do we get the architecture right, and what are some of the principles? So hopefully we can talk about that. So let me just round up on pay. Of course, we have the John Thane example, which is, I think, now my favorite. Someone who had the audacity to propose a $10 million bonus for himself during a time which his company made horrible business decisions, lost about 80% of their value, and then sold themselves to Bank of America to stave off possible collapse. Bloomberg itself has calculated that the 5 largest investment banks, 3 of which, of course, which are now gone, in the last 5 years paid out $145 billion in bonuses, which is larger than the GDP of countries like Pakistan and Egypt. And to us, really, in law school terms, was one big, giant, fraudulent conveyance, in that, obviously some of this money should have gone into shoring up their balance sheets and into capital, but wasn't. And I think the spirit of the debate was probably best captured for me in a recent opinion piece in the Washington Post from Sunday from a Harvard Business School professor and his colleague over at the JFK School, and he said, quote, "Public companies have become largely personal ATM machines from which to extract as much personal wealth as quickly as possible within the boundaries of law, usually." So how should the boundaries be different? Back to the quote, "The distinction between creating something of enduring value and merely extracting as much value as possible has dissolved." I couldn't agree more. So let me finish on how we saw pay itself drive some of the excess and some of the how pay contributed to the economic collapse on Wall Street. And for us, it was very apparent that the way senior executives were incentivized, the way they were incentivized to take excessive risks in the short term was very apparent. And how was that done? Well, in a couple ways. First, through large stock option grants. They had huge incentives to take excessive risk, maximize short-term stock price increases. And then too many CEOs, much too many, had their incentive comp tied to performance measures like revenue growth or return on equity. And not surprisingly, the financial results that they were able to generate in that period when they were paid out $145 billion in bonuses really had little to do with the risk involved in generating those results. So why don't I stop there? There's plenty more to talk about, but I want to have a discussion versus me talking at you. Thank you.
One of the things you mentioned, Dan, was something you were interested in is seeing greater disclosure by short-term holders.
Right.
What are you talking about?
So we're talking about a couple of things, and for us, it's really embodied in what we would call the shadow capital markets. But what would greater disclosure look like? Well, I think it could start with disclosure of long and short positions by hedge funds. It could start with greater disclosure by private equity firms when they're bidding on public companies. But also, incentives aren't going to change, and an orientation of the market's not going to change just by greater disclosure. We're also going to have to see, differences in how short-term transactions are taxed, right? I mean, one of the ideas that's come up that has been debated about, and this would, I think, help steer a funding stream to reform around credit rating agencies, is what about a financial transactions tax on short-term trading of 0.25%? For the average investor, if they're investing $50,000, that would come out to about $125, I think, if my math is right. So it's a combination of both transparency and then greater, other public policy reforms as well.
Well, are you also talking about if you go back to the CSX case, CSX, I know when we were talking before, Dan, we asked him about CSX, and the answer was that the FL-CIO wanted to take a position on that case, but after they canvassed all the various constituencies involved that they report to, they figured out that they couldn't. But in that case, the question was had to do with short-term disclosure, and really sort of complying with 13D regulations as it relates to. In that case, it was the total return equity swaps. Does the AFL-CIO have a view about that?
I mean, a couple of different things. First, I think the CSX board was in need of a shakeup. And I think the way TCI approached it was very smart, both in terms of how they talked about labor relations with our members, but also in terms of how they talked about creating long-term value. So I think that's one good thing to be said. One area of improvement, I think, is obviously, yes, improving how disclosure is made and bringing all, the market has a hard time factoring in or pricing risk if there's a lack of information, if there's a lack of transparency. So, hedge funds and private equity weren't the prime cause or the fuel of this market meltdown. But if we're going to be re-regulating and bringing everyone into a regime of greater transparency, then that's one area of the shadow capital markets we need to shine more light on.
Well, I know listening to Mark in his the list of how you go through these things, I noticed anyway that after deep research came acquiring the toehold. I didn't ask him, haven't yet, what a toehold is, but it was both by buying long and also by buying or engaging equity swaps. And the next step was approaching other shareholders to see if they could come to some consensus about what an approach to management should be. Then was the approach to management. It was only after the approach to management came the actually buy over 5% long and filed the D. And did I get that wrong? At which point you might already have 15 or 20% of the equity through the swap mechanism.
Since everybody has focused so much on the swap issue, first of all, the issue is on appeal to the Second Circuit. So the law hasn't been decided yet, but I think more to the point, the outcry about lack of disclosure, including from CSX, about how we acquired this stealth interest in CSX, is a complete myth. Very early on, in fact, while TCI only was on swap, it approached the CSX management, talked about the company, and their view was, you're not a stockholder. You don't own any shares. We're not going to talk to you. So TCI said, okay. Then they went out and bought long and came back again. Still didn't talk to them, but CSX didn't view the swap as real shares. We had to disclose our intention to run a proxy contest because of CSX's advance notification bylaws 6 months before the annual meeting. They weren't surprised at this approach. They knew all about us, knew exactly how many shares we owned. The only thing that corporate America is trying to do by closing that loophole is reshape who makes the profit. It's that profit incentive to the activist, make it worth their while to go shake up a CSX.
Say the question is enforcing the law, but as we also mentioned before, we're having this discussion, and it's all about this very interesting subject that probably is now largely not relevant at all, since, as Mark told us before, banks, no one is engaging in swaps, and they're certainly not doing it on a finance basis, and they won't do it partly because the law is unclear, because the case is on appeal, but for other reasons too. I mean, largely to do with the lack of credit. So,
yes, correct.
So it's probably a good time to get this worked out, since none of this is actually happening. We can get the law worked out. We'll all know what's real.
It's an odd period for lots of reasons, but it's an odd period for activism. I think my guess is it will be a relatively quiet year, because as I would say, it's a target-rich environment with lots of stocks down and lots of very unhappy shareholders who you would think would be very eager to follow an activist into pushing a company to get its stock price up. The activists, they're having a hard time. They were down 20% generally last year, if not more. They're very concentrated, they're very illiquid. And on top of being down with their own investments, they had a lot of withdrawals at year end, so their assets under management are down. They're under some pressure. Some of the sort of layup strategies for activists about in the heyday of leveraged buyouts, when pushing a company to a sale or getting the company to use its cash on the balance sheet to buy back stock or pay a special dividend, are really not available these days. And so I think my guess is this will be a lull period for activist investing.
But is it true that the Fed or whoever the right regulator is took the position that leveraged equity swaps were not subject to the margin rules?
Leveraged equity swaps were not subject to, yes, correct.
So you could go out and buy a 10% interest in the equity, make a 10% bet and put up 1% money.
Whatever you can negotiate with your counterparty.
Okay. One of the things from CSX was that we got out of the opinion, and I think the Second Circuit has confirmed this up to this point, is that as much as the court found that TCI had engaged in a violation of the law, there basically was no remedy. Now, Senator Schumer, I think it was recently quoted as saying, what, no remedy? Is there anything coming down the track on that?
On the legislative side? I don't know.
Anybody know?
I don't know.
It did cause me to go back and dig out a law that was a bill that was introduced in the Senate in 1980 that, among other things, would have required a tender offer to be made to all stockholders, that they be paid, everyone get the same price, things that came later, but that also included would have provided for real penalties for violations of 13-day. And you got to wonder if it won't be coming back if the regulation gets tougher. So.
This was known as the Lamb Act. It was never enacted,
only in the SEC.
But of course, the reason that the district court and Second Circuit found that they couldn't strip TCI of its voting power was there was a direct binding precedent at the Second Circuit.
Right.
Surely you don't have a problem with deference to prior judicial decisions.
Not at all, no. I mean, courts have to give deference to it, but people making decisions about what the law should be in the future don't.
Right. I want to start with Mark. Dan, in opening his remarks, started off by saying that he and the AFL-CIO are looking for greater rights for long-term shareholders, and that there's a real problem between short-term incentives and long-term incentives. That's the source of one of the sources of the collapse, one of the sources of the problems. And I want to start by saying, Mark, do you and your clients, I mean, is there a problem of short-term versus long-term?
Well, it's a complicated answer. First of all, the studies that have been done have shown that in most cases for activist investors, they own the stock up to a year, or on an average, a year before they become active. And once they own the stock and become active, they own the stock generally for another year. I don't know that a 2-year holding period is really such short term, but it's not probably your holding periods. I think we have very similar goals, but different time horizons. When institutional activists will press a company to redeem its pill, why are they doing that? Because boards will stand behind a pill and prevent the shareholders from getting the benefit of an acquisition, of a potential premium acquisition for the company. What's our view? Sell the company. They'll propose majority voting so that a board member who's on the comp committee, they'll vote against him next year and he'll be embarrassed and have to turn in his resignation, which the company won't accept, or maybe he'll step down, or maybe he'll be a better actor on the comp committee. Our approach, fire the management, or put us on the board. We'll cut the comp. The objections are the same. We are, in that sense, yes, we are more short-term. And for short-termism in general...
You're less patient.
Okay, we're less patient, yeah. As for short-termism in general...
I think if you've seen a union rally outside a shareholder meeting, you'd see that we're pretty impatient too. But yeah, I mean, Mark mentioned one of the tools. The other is proxy access. I mean, the ability to run a short slate or a proxy contest is extremely expensive. it's invaluable to have hedge funds be able to do that. I mean, the Home Depot example, which some of you may have read about, is you had there a dead board. You had there a board that was captive to a serial overpayer named Ken Langone, and who was captive to, for a while, a failed CEO, Bob Nardelli. So it's the turning point in the Home Depot example was when Ralph Whitworth decided to put his money where his mouth was and put up, shake the board's attention and put up a short slate. So how do we enable long-term owners, the patient capital, to really shake the boards and get their attention and make them more accountable? Well, we have, as Mark mentioned, the ability to do that now through majority voting and say on pay is one avenue, but the dynamic in the boardroom is never going to really change unless you change the dynamic where most corporate board elections are like a Soviet-style election, right? You can 99% of the time say, the slate that's going to be put up is going to be reelected, and anyone who wants to run a contest is going to have to spend millions of dollars. The incumbent slate can spend as much money out of the company treasury as they want to get reelected. It's a failed system, and I think that's why.
So here's the question. Are you guys, do you have the same agenda or a different agenda? Are you sort of friends of, is it a marriage of convenience when you team up in a particular company, or is there some long-term coincidence of interest? Dan, you started off by saying that the AFL-CIO agenda is shareholder power, CEO pay, board accountability, and healthcare. I've never heard your clients say that that's their agenda. Their agenda is to shake things up in underperforming companies to make a profit. Sooner is better than later.
Although they would also say that they believe when companies operate more efficiently and operate more profitably, they're more able to grow. All the corporate constituencies do well. They can hire more people. They can expand.
I agree, to be sure. But what's so interesting about the fact that you team up in a bunch of situations is that much of the public discussion has been hedge funds short-term bad, right? AFL-CIO has a long-term worker-oriented interest, and yet there's a coincidence of interest. So my question for both of you is where is the overlap of interest? And more interestingly, where's the divergence? When is it that you're on a different page? Mark, do you want to start on that?
Well, again, I think the overlap of interest is in seeing companies perform better, be more responsive to their shareholders, shareholder power and director responsibility. Activists are looking for that same thing. I think they do have a different time frame. I think they want it now because it will affect the stock price. When you talk about short-termism, my one-word argument to that is tell it to Yahoo. The board stands in the way, the shareholders don't get a premium offer, and then the stock gets crushed. And what did the board argue? Long-term value. I represented Trian in a proxy contest against Heinz a couple of years ago. Heinz had come out with a 3-year plan every 3 years for 15 years. Every one failed. Nobody went after the board. Nothing changed. The stock had not moved in 10 years. There's long-term value. I mean, there's nothing wrong with incremental profit.
Dan?
And I'm sensing in your question that in terms of the issue areas of focus, maybe that there's not a fundamental urgency in return and value creation. And we get this all the time on pay. Oh, well, this is populist outrage. Well, of course, there's a lot of populist outrage. People are overpaid. People are paid when they die. Their heirs are paid. That's absurd. But what does pay mean in terms of return? Well, pay is sort of two areas that are important for us. First is if there's overpay, then I think that's the sort of canary in the mine. That's the dead board, and that's pointing to it. But Lucian Bebchuk had a fascinating study, right? He looked at the rate of pay as a percent of earnings over 10 years from 93 to 2003, and the rate of pay at companies with a market cap of over 50 million, the pay rate doubled. I mean, that's money that was basically given out with very little to show in terms of return or or performance. So if it's pay, if it's healthcare, if it's proxy access, it is fundamentally geared at improving return, but over a different time horizon. Let me just say a few words about hedge funds, because as unions, right, we wear many hats representing members, representing retirees in the public policy realm. I would be interested in polling the crowd. We can't do this, but I'd be interested in what people's definition of a hedge fund is. But let me offer up my own. Hedge fund is a legal structure that avoids regulation in search of an asset class. It's not an asset class itself. Feel free to quibble with or disagree with that definition, if you will. But in terms of our members and their investments, we don't advise them not to invest in hedge funds. We don't advise them not to invest in private equity. But what we do advise them is, invest in modest amounts to round out your portfolio. That it's absurd to think that you can achieve above rate sustained, above rate market return, by investing in leveraged asset pools. And our funds are seeing that now. Who did invest too heavily in private equity and hedge funds? The Pennsylvania State Employees Fund, the Washington Fund, they were invested 30% and 40% in alternative asset classes. So we have an issue around investment. We have an issue around, is there a hidden cost when they take over a portfolio company? Are they stripping assets? Are they trying to flip it on the market for a short-term return? And then I think we have an issue, thirdly, around governance and transparency and tax. And that is, there was a big fight a few years ago around private equity companies going public and what structure that should take and what level of transparency there should be. There was obviously a big fight about the carried interest tax. This is money management income from our standpoint. That these managers aren't putting any money at risk, but yet they're paying cap gains tax. And there's obviously an effort.
Tell us a bit, Dan, and then I'll ask Mark the same question about how when you identify a company that you want to shake up in one of these directions, how do you reach out to the other shareholders? Who do you reach out to? Do you reach out to the mutual funds? Do you reach out to the insurance companies, the charitable trusts, the university endowments, the hedge funds? What's the difference? How do you go about doing it? What's your strategy for?
We would start by reaching out to our own funds, right? Our own public funds, our own union funds, and you could ballpark their level of investment. Funds that union members participate in at about 8 or 9% equity of a traditional public company. So we'd start with them. We'd then broaden out to organizations that bring these investors together. One is a group called CII, the Council of Institutional Investors. There's lots of opportunities there for building coalitions. But then I think it would include mutual funds. You've seen a lot of headway in an issue like sale and pay, and mutual funds increasingly voting in favor of some of these proposals and getting religion about good governance. And then it would also include, reaching out to activists. I think, different parts of the activist investor community have good relationships with a number of these hedge funds. People like Rout Whitworth have partnered up with union funds and investors. And in the case of CSX, we did reach out to TCI and have discussions with them. So it's a whole range of actors that we would want to engage with.
Mark, how do you guys reach out? And who do you reach out to?
Well, generally, we're trying to reach out to any significant shareholder we can find. Unfortunately, the only way you really know who they are is through public filings, 13Gs, 13Ds, 13Fs. So you're only looking at the major holders and the company's proxy statement. We'll talk to them and try to test the level of support and the level of dissatisfaction with the company. Some institutions won't talk to you very early on, and often because the portfolio manager who has the investment may not be the same person who's making the proxy voting decision, and those people will only talk to you once you've got a proxy statement that they can look at. We're also very mindful of the group rules, and that's come even into sharper focus, I think, as a result of the CSX case, and people are warier these days of talking to other shareholders.
And how do you, now the lawyer sort of question, how do you keep your clients safe in terms of talking to other people? I mean, do you sit in on all the calls? Do you have somebody, is a lawyer sitting in on all the calls? Are you recording them? How do you?
We're not. I think the only way to stay safe is literally not to talk to people, because one of the strategies of some defense firms is to sue over this issue, and then again, we're spending our own money to defend ourselves. So it's a very, very difficult line to walk. The law is that unless those two shareholders have an agreement to act together, they're not a group. But somebody's going to look back in hindsight and say, well, you spoke to him on Tuesday and he bought the stock on Wednesday, and who are you kidding? It's really chilled shareholder communications.
So it's the rules under 13D that give you pause, not the rules under 14A. Yeah,
I mean, until you're really soliciting a proxy, you're just talking. And you don't have a proxy statement, you're not asking them to sign anything. It's really the 13D rules.
Under which you can actually get a proxy from someone, and that's not regarded as beneficial ownership, right? It's just the agreement to vote that would be a problem.
No, if you had a proxy, it would be an agreement to vote. If you got a proxy.
Somebody gave you a revocable proxy?
Well, not in a regular proxy, broad proxy solicitation when you get their proxy. That's not beneficial ownership. But I mean, if you went to some other shareholder up front early and said, give me a proxy so I can vote it my way, sort of one-on-one, I think that would clearly be a 13D group.
So Dan, if a hedge fund, hedge funds, as Mark has said, they just want to make money, right? Sometimes you make money by shaking up the management and cutting executive pay. Sometimes the shake-up of the management is that there are more employees working for the firm than the firm really needs at this point, which is to say layoffs. How do you guys strike that balance between your role as investors looking for a higher stock price and
right.
being the AFL-CIO and worrying about your members being laid off?
Well, I think, there are any number of ways to generate value, right? I think the management of Circuit City thought they were generating value when they decided to lay off all of their senior-most employees. And, oh, wait a minute, that was a bad idea because people walked into stores and they couldn't talk to someone who knew what they were doing or knew where to steer them. So I think, we obviously have a view on how to engage with the workforce. We have a view on how to approach managing a company to create long-term value. So let's go back to the CSX model in terms of, or the CSX example in terms of how they approached the company, what they were saying, because I think that's probably instructive. When TCI was talking to us, when they were talking to the press, when they were talking to our members, they described the CSX management's relationship with their employees as confrontational, as strained. TCI was calling for better safety measures. They were also calling for curtailing spending, and they were also, so that can obviously have an impact on the lower wage employees. So I think what we end up arriving at, the question that we call, so to speak, is, are they approaching this company in a way that's going to asset strip, or are they approaching it in a way that's going to, cut excessive fat and stay away from the muscle of building the company's long-term ability to generate a profit?
A lot of conflicts, or just a few, right? Asset strip is something that hedge funds, they have a different word for it, right? Which is getting rid of assets that the company doesn't, that are worth more in other hands than the company currently having it, as a way of increasing shareholder value. I mean, again, it is what's so striking to me, and I don't know if to the rest, is that there is an overlap and yet clear tensions between these two different types of shareholder activists. Not to mention the other sorts of institutional investors who are out there who have a whole set of different sorts of interests. And it does seem, I mean, what's so interesting is that there are at least a range of issues that, notwithstanding these differences, that you guys work together on against a common foe, I guess.
I think when we get Proxy Access, we'll work with Mark's clients much less. I'm just kidding.
If you're doing proxy fights, that'd be fine with us.
let me open it up to comments and questions from the audience. Michael.
Let me pursue Ed's question a little bit further, Dan, if I can.
Sure.
The shareholder primacy Shareholder Access, Shareholder Power, activist shareholders is sort of almost a religion. It's certainly a cause. You guys have gotten aligned with it. And my question is why? I can understand that you could think shareholder access is coming anyway. So I've got a few issues that I want to pursue through being an activist shareholder. But I think on your broader interests in having management take a longer run view, I would think shareholder activism is the last thing you want.
Well, I think the opposite's the case, and I'd point you to a document that's sort of a founding guidepost for us and a way forward, and what are sort of the principles that we're focused on. And then let me talk about proxy access too, because you bring up a good point. President Obama mentioned a few nights ago that the AFL-CIO and the Chamber of Commerce both agreed on the need for stimulus. Well, one other thing the AFL-CIO and the Chamber of Commerce and the BRT have agreed to is a founding document from the Aspen Institute, Principles for Long-Term Value Creation. So we're about long-term value creation because of the time horizon of our funds, because of what that approach means for how businesses are governed. The Aspen Institute document talked about forward-looking incentives, about long-term oriented firms that are built to last and expect to create value over 5 years and beyond. So I think shareholder value, shareholder primacy, that can veer into a bad direction, right? Some of my colleagues are, I think, sometimes too focused on the short-term stock, the share price, and their critique of companies. That's.
If I think of the guys behind and the money behind Mark and the guys and money behind you, I would think Mark's got a much bigger sword to swing on this issue than you do. Because
part of his money is from our members' pension funds, right? From CalPERS, from the big public funds. I mean, we're talking about a universe of $6 or $7 trillion. So these are the universal long-term holders in the patient capital. But I think to your point about access, you're exactly right. I mean, access would be terrible if it meant that people only had to hold, the people had to hold 5% of the company for only a year. I think we want to see a workable access rule so our funds can join together and propose a slate. And the holding period should be not 1 year, it should be 2 years or 3 years or 4 years.
Are you working on proposed, maybe, I guess this can go two ways. One way it could be done, state law could come around to either by amendment or by whatever to recognize the right of stockholders to propose or recognize the fact that proxy access bylaws can be adopted and be enforceable.
Either ways, I know that the Chancellor, Leo, has a strong view on this. I think either way is doable. My personal preference, not speaking for the AFL or anyone else, would actually be the bylaw approach, the AFSCME approach, which I think is more workable.
Right. Well,
but I think what we're going to end up getting is
probably coming. So, but are you working with business groups in drafting model bylaws?
Business groups, hands down, oppose access.
Well, they may oppose it, but are they? I mean, you're mentioning the Business Roundtable. Are they involved in discussions about what the bylaws are going to look like? Because my assumption is that if it happens, if state law is changed to recognize that stockholders have a right to propose bylaws, and I suppose you'd have to get the SEC to flip over its interpretation again, which it probably would.
Right. Back to their long-standing interpretation. Right?
Yeah, the long-standing interpretation that was the opposite of their prior interpretation. But if that happens, my guess is that boards are going to want to get ahead of the curve and start adopting bylaws or dealing with you in adopting bylaws that are palatable to them, and that serve everyone's interest.
That could be right. We're just not seeing it. I mean, we know they're doing something similar, sort of preemptive around say on pay, right? You've got an increasing number of companies who see this coming down the pike who are adopting it. But, if it's the BRT and the Chamber, what wasn't included in the Aspen Institute principles was access, was a discussion of the need for access, because I think they're defending these boards against any and all accountability.
I'm sorry, but it did happen in majority voting,
right?
Didn't it? I mean, the boards kind of got ahead of that and adopted bylaws.
We're talking about a different ballgame in terms of an affirmative measure as opposed to a vote down or a vote against and a precatory, right?
Right. Well, but if it happens, and I imagine it is going to happen, then I guess they're going to go ahead and do that. But so without them, are you working on bylaws?
Look how open
we are.
Look how open boards have been to 14A proposals.
Right. Well, it's getting better though. It's getting better.
I thought the SEC was the problem.
Joe?
Hi. I've got a multi-part question for the panel. I guess my first big question is who cares, right? Short-term interest, long-term interest, who said one was ever better or worse than the other? We're living in a world now where short-term fixes are important to keep the market up, to keep the market alive. And there's this notion that, if short-term interest is speculative, right? Puts are speculative, but longs are in the best interest of companies. And I guess I'd like to hear why that's the case. I haven't heard an argument yet that says long-term interest good, short-term interest bad, and why that's the case, number one. Number two, we talked about disclosure of puts and calls, and for the SEC to change, I guess their definition, they'd have to change their definition of beneficial ownership to proactively and expressly require the disclosure of puts and calls. What does that do to a company? Let's say a Chanos shorts a company, makes it public. What happens to the long-term shareholders in that company and the value of that company if then you've got the free rider problem? The number three for Delaware, what does that mean for the empty vote, no vote argument? And if in fact you're going to call a swap beneficial ownership, are you then going to afford that guy the same right to books and records of the company, dividends, other rights that are associated with with shareholder constituencies? And
well, on the empty voting thing, there's read the piece that he wrote with Marcel Cahan that explains it all. I mean, it's a little piece of its Delaware law, but it's largely a problem that results from the way the voting structure is set up through the depository system.
But if you're going to consider, if I'm long synthetically, am I a shareholder or not? And therefore, do I own the rights of a shareholder under Delaware law? I mean, forget about the SEC, just basic corporate law.
No, you're not. Why not a shareholder? Because the other guy's the shareholder, I guess.
I shouldn't have
I'm not here to answer questions.
Mark, Dan, do you want to respond?
Sure. So to your first question, why is long-termism better than short-termism? Short-termism has its values if it's done in a productive way, right? If it's done to shake up a board or change implement some long-needed changes. But I think what better example of the need for a long-term orientation than the failure of the markets over the past 20 or 25 years when they're oriented towards short-termism, whether it's pay or managing the stock price from quarter to quarter or just taking a view that creates all the wrong incentives. So the Wall Street collapse is the best example for us. That was all based on short-termism. I don't have to worry about the creditworthiness of the product that I'm buying or underwriting. It's going to go on to someone else. I don't have to worry about any sort of long-term effects. So,
can I make the same argument as a short-term investor and say you're waiting too long? Where is the value going to come? By the time the value comes, 5 different markets will have passed you by. What makes that any better than a short-term investor? I mean, I'm sure if within a year the stock popped, you wouldn't be unhappy with that.
We wouldn't be unhappy if the stock popped?
With the value of your stock rising.
Right, but I think the reason we can come around and agree on these principles for long-term value creation is executives and CEOs just recognize that the way they've had to govern their companies over the past 10 years has been completely failed. They were worried about answering to people quarter to quarter. They were worried about hitting earnings numbers, and what did that mean in terms of pay, in terms of manipulating their profits, and I just think it created all the wrong incentives. And we're more focused on long-termism because of the time horizon of our funds, obviously, but I just think the formula that is driven by short-termism in any of these areas has been proven to be a failure, not just in terms of what we're going through now, but in terms of return on the stock market. And what has the stock market done since we deregulated and allowed better short-term incentives? It's half of its long-term rate of return from 97, 98 until now compared to the prior period. So,
Mark, you want to jump in on it?
Oh, look, I think the people who make the short-term arguments, I was on a panel with Marty Lipton last week, and he was making his short-term speech and long-term speech and said that the pharmaceutical companies, it's more than just the short-term pop in the stock, it's the long-term commitment to CapEx and research that they're arguing is why long-termism is better. And his example was the pharmaceutical industry, which I think is a good example. The pharmaceutical industry puts tremendous amounts of money into R&D, hoping for that grand slam drug. And when they get that grand slam drug, many of its shareholders would say, congratulations, time to take chips off the table, I'll take my money back, please, enough at the casino. If you're a pharmaceutical company executive, that's the end of your job. So if you're a pharmaceutical company, no, I'm going to take that money and put it back into R&D and see if I can get 2 more grand slams. Is one right or wrong? If you never put that money into R&D, you never get any of the drugs. Should it be public company money? Should it be venture capital money instead? Should it be pension fund money that's got a much longer term focus than common investors?
Let me call on Roger Kimmel from Rothschild is here and has worked both with hedge funds and on the other side of hedge funds. So, let me turn to you and get you to talk a little bit about your experiences with them.
I've had experiences both when I practiced law and as a banker and as a director. I clearly see the distinction and the tension between the short term and the long term. One perfect example is really repurchase of shares. A company I was involved in was being pressured by an activist to repurchase shares and leverage up the company. The board resisted. We were threatened with proxy fights. At the time, the stock was in the 30s. The board eventually authorized a buyback at 20 and 24. And my commentary to the activist was that if we had bought it back at 35, that would have been the basis for your proxy contest because we didn't know what we were doing. I think I sort of want to go back and say, I've been on boards for about 30 years, and there is a complete remarkable difference between 30 years ago when I'd be the only person in the room asking a question, and today, all the boards I've been involved in, both as an advisor and as a director, it's completely different. The directors are prepared, lots of reading. They're very sensitized to the hedge fund, to the union world. They're sensitized to risk metrics. People, if you're in a proxy contest, you don't know who owns the shares the next day. It's very hard for anybody to tell you where that's going to be held. So it's, to me, a completely different world. I understand what Mark's saying. I'm quite surprised at a lot of people still being asleep at the switch. Then I'll tell you another thing that I found was quite interesting. In one case, the activist fund started with the management and the CEO, whom they clearly did not like. And eventually they started calling the directors after they felt stonewalled by the CEO. The directors then decided, what do you do? Should the directors talk to them? We concluded it was appropriate to talk to them because they weren't one of these activists that were, were renowned for they actually had some thoughtful ideas. The biggest problem comes for a director is, you don't remember everything that's been said publicly. So before you meet with the activist, so you can actually respond to something they say instead of looking like you're stonewalling. I spent a day and a half studying every one of our public announcements so I would make sure there'd be no selective disclosure. People don't realize that kind of pressure that you're under in those circumstances. And the other thing that you find is you might be sitting at the other side of the table as a board member completely agreeing with what the activist is saying, and the board is already focused on it, but you can't tell the activist that, which creates, a serious problem.
Can't you just wink and nod or have a subtle sign?
Maybe if I didn't practice law for many years, I probably could do that, but I can't bring myself to do that. So it is a different world, and directors today are very mindful of it, and it took a while for the activists to realize that we were on the same page when the board took action. I will say that another thing people don't always perceive, there may be if you have a board of 7 or 8 people, there may be 3 directors that really would like to do X, Y, or Z, but they can't bring the rest of the board around. And sometime when the activist comes in and sends a little note, it gives you enough ammunition to move the rest of the board where you wanted them to move. So I don't think everything the activists do is wrong or bad. I mean, I think a lot of it has been helpful, and it does keep you on your toes, and there's no question that's where it is today.
Can I just say a quick word about our relationship with directors? I would completely agree with the statement that boards are much more prepared, more responsive, there's much better access. We've definitely seen a shift and a change in that. And that's not just the activist community, that's our friends on the other side who work with boards proactively, who are saying the same things. I will say, though, it's still stunning for me sometimes how dominated a board could be by certain CEOs. And one example I'll give is we went in and the beginning was good. The board and the CEO, the comp committee chair and the CEO agreed to meet with us. We went in and talked to them, had a great discussion about their long-term outlook, about the proposal we filed. But then we started asking questions of the comp committee chair about, why did you move the goalpost in terms of the metrics around the bonus? And instead of the comp committee chair answering, the CEO broke in and said, well, here's why they did this. When we're talking about the CEO's own bonus award, when we asked the comp committee chair, what do you think about say-on-pay and some of these other proactive measures, the CEO burst in and said, well, I think say-on-pay is a terrible idea. So I'm much more heartened about boards' responsiveness to who they represent and their preparation, but I think we've still got some progress to make in terms of boards being more independent and pushing back and asking the tough questions in meetings, which we're just not seeing in too many cases.
Well, I agree with you that some CEOs still don't get it in terms of where it is, but the hardest decision for a board, and I've been there with people, is to change the CEO, because your great fear is, what happens if you pick the wrong person next?
Right.
And it's tremendous responsibility, and I think that's one of the priorities of a board. But that's what gives a lot of leverage to that CEO sitting in that room, because they know you don't want to do that.
Stuart Grant, you want to jump in?
I guess I've been very polite, very good at trying to push them a little bit, but since I didn't have to invite him here, I think it was harder. When working with activists, there really are 2 camps, and you've got both camps there. And I have found that there is actually very little overlap with the 2 camps. And I'm going to say some things that probably push a little farther than the truth, but maybe that will just bait them into the debate a little bit. On one hand, you have the hedge funds who do think short-termism, and they're just in it to make money, and if that means coming in and stripping assets or cutting employees or doing whatever needs to be done, parenthetical, and many times it does need to be done, they're willing to do it to get the quick pop, and even if it's cutting R&D and into the muscle or bone a little bit, if they can get the quick pop and get out, do they really care? So that's one camp. The other camp is labor, who, if you notice the issues that were laid out, and they were laid out very diplomatically, most of them don't have to do with the business itself and how much profit they're making. Many of them have to do, the health care, that's very much related to employees, their union members. Several of the other agendas, if you look to see what's put out, have to do with that. So each have their own core values of what they're pushing. But the interesting thing is the third leg of the stool that you didn't invite here is actually management now. Because I think what you're going to find in the next several years, and it's started to happen now, is management is negotiating and playing the 2 off each other. On long-termism and, should long-term shareholders be given extra dividends, extra votes, and things like that, you wind up having management and labor on one side against often the hedge funds. Sometimes when it comes to, gee, we'd really like to make some of these cuts, we'd really like to do some of these things, but we're getting a lot of pressure from our unions and some of our shareholders. Well, if we come in and put the pressure on, maybe we can do some of the things that you've been unable to do. So maybe I can push a little bit on your 2 guests. Can you talk about how the third player, the corporate management, comes into, and whether you have been approached by them because of the introduction of the other activists into the equation?
Let's start.
It's easy for me. I can't remember ever when management has tried to ally itself with one of my activist clients against labor. No, haven't done it. They usually view us as the enemy, and they barely talk to us.
Let me first just make a quick point about the healthcare issue, because that is near and dear to my heart. The number one competitive concern for companies is healthcare costs. The BRT says that about their membership. The majority say healthcare is their number one concern. It's the concern of Boeing competing against Airbus. One has healthcare on their balance sheet, the other has healthcare provided by the government for their employees. So I think that directly relates to profit and long-term value.
Okay, so let me withdraw that and then turn around and say, I don't know that the labor funds would support a short-term pop in the stock if it meant a dramatic reduction in selling off assets and cutting labor.
Right, of course, because what does a short-term pop in the stock get you? A short-term pop, and then over the long term, probably it's something that's not sustainable. But I was just about to agree with you. I think your question is right on, because, and I hope I alluded to this earlier. If not, I'm going to have hell to pay when I go back to talk to union members and my bosses. We disagree very loudly and vocally with hedge funds and private equity. We had a hell of a fight with one of the largest private equity firms a couple of years ago. But I think there are a range of experiences and a range of outcomes. So we've seen some good and some bad. But I think you're right. Management, if it's the Aspen Institute principles, sees us as an ally because we're more focused on long-termism. But we can wear both hats and intermingle with both constituencies. But you're right that the two probably play off each other all the time. We saw that at TCI, I think, in the CSX engagement. I think in looking at how some of the unions, not the funds, but the unions came out and endorsed either management or the TCI. It started pretty early on with some unions, endorsing TCI, and then I think somewhat neutral, and then some supported the company, Mark, as you said. So that dynamic was in place right there, I think, as both sides made their case to union members and their funds.
I actually don't think the premise is all that controversial, in fact, that there is a world of difference between the generally long-termism of pensions and union proxy proposals derived from those shareholders and the types of proposals derived from hedge funds. And to disclose my own perspective on that, I'm an investment banker, typically represent companies, and I'm often on the receiving end of these proposals, and I'm often negotiating with these shareholders. Can't tell you how many times, we've had the experience of listening to the shrill squawking and screaming of hedge funds who are proposing things that nobody could possibly implement, and then you make peace with the guy and you bring him onto the board, and he recognizes that half the things he was ranting and raving about are not implementable anyway. In the meantime, he moved the stock around and created a lot of dust in the air and so forth. I guess my question, now that I've disclosed that bias and suggested it's not controversial, but my question is really to Vice Chancellor Lamb. We've just come out of this awful period in which stocks have appeared to have been worth a lot more than they now appear to be worth, in which activism took on new hold in the marketplace. If you went back 20 years ago, the basis for skepticism about hedge fund proponents was that they were green mailers, a phrase you barely hear anymore. I think today it's probably this concern for short-termism, that they have created momentum only to get out, that they have pushed for leverage and special dividends only to leave companies hobbled, all of those issues. Should the law care? I think that from a management perspective, they are often misguided. They may make a profit. I think Mr. Weingarten was very honest intellectually in saying they are in it to make a profit, and he was very honest intellectually in saying they tend to be in for a year, take their activist sledgehammer, and within a year they're out. They may have gotten a bunch of people on the board, but they're out. And nothing, from an investment banker's perspective, there's no such thing as a more deadbeat director than the guy that was put there by a hedge fund after the hedge fund is out. He's now sitting on the board, not adding a whole lot of value. But should the law care? Now that we've all had this bubble market that has collapsed, this momentum-driven market that has taken its toll on the economy, should the law take a skeptical view of hedge fund proponents who are fighting for proxy rights, shareholder rights, when everybody kind of knows where they're coming from?
I don't know. I mean, the question presupposes that the issue is presented to a court in a way that any court would ever really consider it that way. And I think the answer to that is no. I mean, people end up as litigants for one reason or another. In the hedge fund activist people end up in court because they're fighting over advance notice bylaws, or they're fighting over access to books and records, or they're bringing 225 actions, or that sort of thing. And I don't believe there's any difference in how the law regards their application than anyone else's. Now, I was saying to Mark, kind of in jest before, that the cases I've had involving, say, advance notice bylaws, and there were the two reported cases that involved advance notice bylaws, but I had some others. I had people, these very sophisticated, deep research people who come into court and hadn't read the bylaws. So I don't know where all the deep research is. I had another case where a hedge fund sought appraisal for about a $50 million position that was bought out in a third party, in an arm's length deal, more or less, and came in discovery, said that they didn't have a single valuation document in their files. More deep research. I mean,
there was a range of activists out there, there's no doubt about it. But what I would say in response to that question is that I don't think you can justify the business judgment rule without being vigilant about giving shareholders the right to throw the bums out. You can't justify giving directors the benefit of the doubt all the time. Okay, they were voted in, give them a chance to do their job. As long as they don't steal, it's fine. But the underpinning to that is, because if you don't like the job they're doing, throw them out. And I think what we're seeing more and more of now in advanced notification bylaws is companies reacting just the way they did to 14A8, throwing up any kind of barrier they can to see to it that you can't even nominate a director at the annual meeting.
Those kinds
trusting
of cases,
the courts to be vigilant.
Those kinds of cases you can bring to court, and you know, if it's really what you're saying, you'll get relief.
Filed today.
At least in the Court of Chancery. If it's what you say.
This, of course, is a meeting of our seminar, and the students are here and have done the reading and so forth. So the students should be raising their hands and asking questions or making comments as well. As in class, when they don't, we call on people. So let me first invite any of the students to jump in before we continue opening it up to everybody. Any of the students want to jump in here? Don't be shy. Charles, you always talk in class, so I'll turn to you.
I just stepped out for a minute, so maybe someone asked this, but I'm a little confused in terms of the healthcare proposals. I don't understand. I mean, on the one hand, they seem sort of like telling Dow Chemical not to make napalm, but how is assuming all the companies adopt this, what's the mechanism by which this actually makes a difference?
Because I think one thing we saw 15 years ago when we had the healthcare debate, the fight, is companies like GM and others who healthcare is a competitive issue for them, Boeing, who were co-opted or somehow strangely silent about the need for reform. We can go into why that happened or not, but I think the proposal itself is a vehicle for getting companies to start to define themselves about the need for reform and establish some common ground with other constituencies and other actors. So I think you're right. I mean, the healthcare proposal itself is precatory. It's something that companies can adopt and move on. But we are seeing, helpfully, companies use this as a starting point. So there are always emerging coalitions of labor and AARP and public companies. And I think the proposal gets that ball rolling as well. So whether it's advocacy on the Hill, whether it's joint op-eds, this is a starting point to say, we agree these are the basic principles needed for comprehensive healthcare reform. We agree we're not going to be silenced by ideologues or people who want to maintain the healthcare status quo. And here's a starting point for engaging in that. And you would be amazed, for something that seems so innocuous, this was fought absolutely tooth and nail by the Chamber about a year and a half ago in letters to the, just outcries to the SEC, to the Department of Labor, saying, by no means can you adopt this or allow this proposal to go on the proxy. And it actually led to one of the proudest moments of my life, where I was called out personally on the Wall Street Journal editorial page for trying to hold companies up. So there is a little bit of bark, there is a little bit of bite behind the bark, I think, and substance. But that will play out, I think, as the healthcare debate gets started.
Mark and Dan, let me ask you to talk about the future. This shareholder activism has been with us for a long time, and of course in the last 12 months everything has changed, or at least a lot of things have changed. How does the meltdown affect what's going on, Mark, and with your clients in terms of the sort of shareholder activism they're engaging in or not? What's going to happen? What do you see happening in the next year? Dan, the same question for you.
Well, to use the S word, in the short term, I think it's going to be not very active season for the reasons that I alluded to before. The activists are hurting in many cases, and a lot of the platforms that are the sort of easy wins for them are unavailable at the moment. I think it will be back. It's historically been a profitable strategy, which is why so much money flowed into it in recent years. There's no reason why it shouldn't continue to be a profitable strategy and therefore attract more capital and therefore enable more activism. I think for a while, my guess is that there'll be some movement away from what I would call balance sheet activism, which was, again, sell the company, spin off, leverage up, pay a dividend, buy back stock, all sort of financial fixes, to more operational activism, a la Nelson Peltz at Heinz, and really a la TCI at CSX. It was not sell the company, it was not pay a dividend, it was operate more efficiently. You can be more profitable.
How many varieties are we going to have now?
Heinz has done okay, and the board works very well. I think there'll be more operational activism. I think that will also, in recent years, the activists have put up much better quality candidates for the board. It started out where it was the guy who ran the fund, and now I think they're finding much better board candidates. I think there will likely be continuing what they call convergence of activist funds with private equity funds. We did a proxy contest last year for CNET, where JANA Partners, which is the activist, teamed up with a venture capital firm and some operators. I think you'll see a lot more of that going forward. I think the activists will hire operators to work with them. I think they'll team up with VC funds, they'll team up with LBO funds, and they'll team up with strategics going forward.
Somewhat different question, but regulatory future for hedge fund operators? Any ideas?
Yeah, they'll get regulated. I mean, it's just political necessity. It's, in my opinion, it's ludicrous. When the Congress last talked about systemic risk and hedge funds, and that's why they needed to regulate the hedge fund industry, but didn't. Where did it end up? The greatest systemic risk to the country came from? The most highly regulated industries: banks, insurance companies, and investment banks. It wasn't the hedge funds. And
the hedge funds 10 years before.
Really smart people left those regulated businesses and started the hedge funds. They got to drive them back into the core businesses.
I think they're going the other way. I think they're still going the other way. I don't think registration by the SEC will be. It'll happen, and it will be of no consequence. And if the Congress really wanted to regulate hedge funds by somebody who knew what they were doing, it wouldn't be the SEC. I think it'd be the Treasury. Because when the SEC sends its examiners in to examine a hedge fund, they haven't the faintest idea what they're looking for. They'll never figure out the risks. So it's any idea that
Gets them out of work hedge
people
fund guys.
people would be protected because the SEC registers hedge funds is just ludicrous.
Just so we don't have a short memory about hedge funds and systemic risk, we should remember the long-term capital management example. But I think to the question, though, we are going to see getting right the financial architecture is going to be of paramount importance. So we're going to see that happen, and then some of these other reforms will be implemented. So, but more questions. Sorry.
I'm hearing about products actually getting regulated as opposed to the hedge funds itself. For example, requiring margin, broadening the definition of securities to include credit default swaps and other things like that, the standardization of products and forcing them to cross on exchanges so that you're not worried about the credit behind it. That's where I see at least the significant challenge to hedge funds.
Well, I don't think it'll be a challenge. I think you're right. That is what will happen. It makes a lot of sense to have established exchanges for CDS so that you know who your counterparty is and can they take the risk and will they pay on default. And I think that kind of stuff will happen, and that's fine.
But once
you know, regulating hedge funds,
isn't your leverage going to be affected by this?
It's out of my pay grade.
Well, I mean, if you assume that the margin rules now are going to apply to things like credit, equity swaps, and that the ability to make out-of-size returns based on leverage goes away, I think it's got to then attack the 220 structure too, doesn't it?
Well, I think the 2 and 20 structure is going to be under attack for a lot of just simple economic reasons. People aren't going to want to pay it anymore. The high water marks are so far underwater that they're going to have to adjust their compensation. And as we were talking about say on pay earlier, I think it's, hedge funds are hard pressed to be arguing about absolute pay caps for corporate executives. But, the 20% is just a piece of profit. So, but I think those numbers will come down inevitably just by the marketplace.
And be taxed as regular income, I suppose, right?
So when they change the law, they change the law.
One thing, could you discuss the role of the corporate governance firms? Because I think they're a significant player in the activism, because when I'm on a board, everybody is focused, just like you're focused, on how are they going to vote, who are they going to recommend, and I find that sometimes they do their homework and sometimes they don't.
They're a big part of the
thing. The other thing I always found shocking is that they advocate separation of the chairperson and the CEO, and in their own firm they don't have it separated.
I think Risk Metrics has done that, but you're right. Sometimes they don't eat their own recipes. I think our basic benchline calculus is that Risk Metrics probably controls anywhere from 20 to 25% of the vote in terms of their recommendations. You have Glass Lewis and Proxy Governance as well. I think we may disagree with them on particular recommendations about directors or proposals, but we have found them to be accessible. I think companies would say the same thing. They may disagree, but they find they get a fair hearing. But they have, of course, outsized influence on proposals. And if we're talking about a majority vote for a director, if that director starts out with 30% of the vote against him or her, that's a big deal. So you're right to point to them.
Dan, do you want to talk about the difference that the meltdown makes and where you guys are going to go from here?
Yeah, I think it's interesting. If you talk to someone like the SEC chair, she'll say she's almost has two jobs right now. One is overseeing the commission and revitalizing the commission and actually enforcing the laws and establishing a real cop on the beat. But secondly, getting the financial architecture right, because that's substantively what failed us here as well, both enforcing it and the actual jurisdiction of it. So where we're going to be spending a lot of our time and where we have spent our time is on this question of, all right, if there is going to be re-regulation, if it is going to be the first time in 80 or 90 years that we've really had a live debate about this, what's that going to look like? So one of my colleagues is on the oversight board that's been charged with overseeing TARP. It's the Congressional Oversight Panel. And his group just came out with a set of recommendations around both broadly held principles for re-regulation and also specific ideas that you could see embodied in law. So, it's what we've all heard about, right? It's risk management, transparency, and fairness in terms of the principles. But then in terms of the 8 specific recommendations, number one, obviously, identifying and regulating financial institutions that pose systemic risk, which, I would say is really code for who do we bail out going forward. And this goes to Obama's speech almost a year ago, where he talked about the need to regulate institutions for what they do and not who they are, and what is that going to look like. To the Vice Chancellor's point, I think there's also going to be a big push around limiting excessive leverage in financial institutions, capital requirements, and that's part of the recommendation of this Congressional Oversight Panel. And other things that we've talked about, right? Regulating the shadow financial system, creating different executive pay structures and incentives that discourage excessive risk-taking. Obviously, reforming the credit rating system is a big issue. We had this system where firms would basically pay for the grade they wanted. I'm sure you guys wish you could do that in law school. And I think there's going to be a big discussion about what does international regulation look like. And the focus of the panel was making sure that the U.S. Is the global financial regulatory floor. But it's obviously going to be interesting at this G20 conference about how the U.S. fits into the efforts of Germany and some of these other countries that have long been saying we need to do something much different around re-regulating. But this is less a governance question, but more about what are the rules and what's the architecture going to look like.
Can I press you a little bit on that date? With Damon Silvers now on the TARP panel, and having been active in the AFL-CIO corporate governance activities, with respect to things like changing executive pay structure, is the idea to make this mandatory on firms, to make this, to push, say, on pay or various other proxy access proposals so that shareholders could push this on individual firms? What's the thinking on this?
I think a couple things. First, I'd say 90% of Damon's time now is taken up by the Congressional Oversight Panel. So he's less, in our meetings and consulting with us, and more conducting hearings and pushing for recommendations here. But I think if you look at their report, it doesn't, this is in many ways a different debate than some of the tools that we're asking for in the corporate governance system. So they don't talk about, I believe they don't talk about say on pay in their report. They don't make clawbacks mandatory for that fraudulent conveyance that I was talking about, but they do agree that getting pay right in terms of the incentive structure is something that needs to be done. Damon's experience here probably helps inform some of his recommendations, but I think he and the other panelists are focused on sort of a broader picture.
Does the meltdown affect your proxy strategy for the coming season? There are different issues that you're focusing on than you did a year ago?
Well, I think our funds may need. Our funds, first of all, are probably down anywhere from 20 to 30%, maybe even higher in some cases. So there's a question of their viability, of their willingness to engage in this work. And I think what we hope to prevail upon them is this work hopefully get to some of the root causes of what brought about the meltdown in the first place. But they're going to see, they're going to need to reallocate their portfolio. They're going to need to focus on sort of staying viable and, pushing back against political attacks on defined benefit plans. But I think you are going to see, you were asking about what can we expect in the year ahead. CalPERS is sort of the big model for a big public pension fund that's active. I would tell you, don't be surprised if you see other funds, especially big public funds from red states, who get more active in challenging boards and filing proposals and in developing their own proxy voting guidelines. That's going to happen, and you'll see more CalPERS-like funds be active in this area.
And they're going to focus. As somebody who's watched proxy fights year in, year out, there are flavors of the year, right? I mean, there are some years when one sort of proposal is the popular, so other years it's something else. Sometimes it seems to be related to what's going on in the economy, and sometimes it just seems to be, like, shoes or clothes, right? I mean, whatever the fashion is. I'm curious in terms of what the topics are going to be that the union side funds focus their attention on. I think
many of the same that I talked about. Many geared at pay. I mean, say on pay is one proposal that every member of the Council of Institutional Investors gets behind. Some of the most conservative funds and some of the most aggressive funds. I think they do see it as making a difference on. We look over to the UK. Say on pay has had the effect of not lowering pay awards, but changing pay awards that are doled out where the performance doesn't merit it. So it's some of the plain vanilla proposals like declassifying a board, separating the chair and CEO, but I think a lot are focused on pay as, as I said earlier, maybe that canary in the mine indicator that the governance of the board and the oversight isn't sufficient.
Joe? He's a co-teacher here. He's not on the panel.
To what?
And the question is, if that's the case, how would you harmonize that with just, the foundation of Delaware law that states shareholders have limited liability, number one. And number two, would you apply equally to not only kind of the hedge fund, private equity fund, activist investors, but to the labor unions who try to impose policy?
Well, I don't really understand the premise of the question because the basic, I think as you just said, the basic principle of the law is shareholders acting do not act as fiduciaries.
So you don't expect there to be discussion around the notion that activist investors who have owe a certain duty to the shareholder constituency?
I think the answer is no. I suppose the only thing I can think of that might get close to what you're suggesting is activist shareholders who say come to court and file papers in court, take positions in court that are based on half-truths, will find themselves getting in trouble with the court. I don't think it's a fiduciary duty concept.
I think it's going to be geared more at, we saw this in Proxy Access, geared more at greater disclosure than fiduciary duty.
You can actually, it's something I'm thinking about and beginning to write about, which is you can certainly come up with scenarios where a fiduciary duty claim would be plausible, where you have a group of activist shareholders who work together, who collectively get to a position which under Delaware law could be considered a controlling position.
Well, of course.
And then act in a way that is not in the interest of the shareholders generally, but for their interest. Now,
if in doing so they exercise control over the corporation, then you've crossed the line.
Then you've crossed the line.
And the other line I can think is if you're soliciting proxies, your proxy solicitation isn't governed by Delaware law, and generally our law of disclosure is based on fiduciary concepts, and it generally applies to directors. But if you could reach some point where you are collectively with somebody else exercising control, and I suppose we could look at your disclosures under fiduciary duty concepts. Maybe Stuart Grant has some other ideas about how he's going to bring this complaint. But
I'm sorry, what's a controlling shareholder's fiduciary duty under Delaware law?
I can't hear you.
I'm not aware of what a controlling shareholder's fiduciary duty is under Delaware law. You're suggesting it has one.
Controlling shareholder does have fiduciary duties in exercising control.
In exercising control, but can still, for example, block a transaction which it doesn't find in its economic interest, et cetera. So it has a lot.
You're entitled to vote your shares in your own interest.
That's what I'm suggesting.
This is a topic I'm very interested in, so we can go on this. Because I think actually there's a decent claim that can be made in the right circumstances. It fits comfortably within existing doctrine, but that's rather beyond the scope of shareholder activism. Let's get some additional people in here. David Musto, do you want to jump in? You've done a lot of research on votes, buying and selling, and the way shareholder activists work.
Yeah, I'm not sure any that's specifically relevant here. I was just been thinking, you talk about how do the union incentives differ maybe from shareholder value exactly. I would think unions, thinking of how they create value through collective bargaining, they have a big interest in large and long-term companies, because collective bargaining could easily die with the company, and a large company gives them more kind of hold-up power. And so they have an incentive. Their incentive is sort of skewed in the direction of supporting like lower leverage and whatever it is that keeps the company more likely to persist and gives more life to their collective bargaining agreements. And for the hedge funds, they have they're short-term. There's nothing wrong with the short-term perspective as long as the market values the right thing at that moment. And so that's sort of the difference that I see, that the market values something. You're talking about the flavor of the month, whatever it happens to be. Right now people think a bit, free cash flow is a bad thing, so you should pay out a big dividend. Other times right now they don't think that, right? So it's not the flavor of this month, right? So market values different things at different times, and if the market values the wrong thing, and then you have that skewed in that direction, and the unions have this skewed towards let's have a GM that just lasts forever and maybe gets too big to fail. So in a bad situation like today, they'll get bailed out, and our collective bargaining will persist. Whereas if they're smaller, not too big to fail, or if they do fail, then there goes our collective bargaining agreement. So that seems to me a potential, where their incentives differ from necessarily value creation.
Avery, do you want to jump in?
Yeah, so since we started on the finance perspective, so I would just want to add to what David said, that basically the way perhaps we would look at that is more in terms of different interest groups. So for example, as David said, labor unions should probably be more aligned with bondholders in terms of thinking in terms of risk preferences of what kind of things you would like the firm to be doing. So I think that we would view it in terms of risk preferences, and different groups that will view it in different ways. And obviously, if a labor union is trying to be active, they will do different things than hedge funds. And the other issue that I would say is more issue of information. I mean, I kind of agree with David that long run, short run is a little fuzzy. Because, for example, suppose you're buying for the short run, you have to sell it to someone. So if the other person is convinced that you ruined the firm, he's not going to buy the shares from you. So you either have to cheat or you have to have some sort of asymmetric information. In other words, you know something, they don't. So I think that these issues are the issues that the way we would view it, because short-term, long-term is a little bit, what is short-term, what is long-term. But what are different groups with different interests and what is information, I think this is kind of easier to view it in that perspective.
Let me put those comments together with Michael Wachter's earlier comment and turn it back to first Dan and then Mark as we come to the end of the class. Michael's point before, and in a sense David and Avery's point about the differing interests between shareholders, bondholders, and employees. Michael's point before is, I take it that the idea of shareholder access, the idea of boards that are responsive to shareholders, is ultimately for labor a dead end. That it is a trap, if you will, from a labor perspective, because ultimately labor has always benefited from managerial slack, if you will, from the ability of managers to avoid shareholder primacy, shareholder profit maximization, because by doing that, that leaves more for the employees. And so Michael's done work on the corporatism of the 1930s, which was critical to the growth of collective bargaining, was limiting foreign competition, limiting shareholder pressure on managers, because otherwise there isn't anything there for the workers to get. So that Michael suggested, and it's very much Avery and David's finance perspective, is there's a fundamental conflict of interest between capital and labor, if you will. That hedge funds ultimately are looking to maximize the interests of capital. And that labor might think in the short run that it's a useful lever to gain some advantage on particular issues, or to engage in, hitting managers over the head, which is always a nice thing to do, but that has labor thought seriously about whether they're making a pact in pushing for greater responsiveness of boards?
Yes.
A pact with the devil?
Yes, because you see a divergence in some parts of the labor community about the attitudes of poison pills, declassifying boards, proxy access, even say on pay. And I think the worry is that you are opening management maybe to short-term impulses. But I think that goes back to what I was saying earlier, the need to construct a proxy access rule that's workable for long-term investors to be able to use it in terms of the holding period, in terms of the ownership levels. And I would say I got to hardly disagree with the fact that labor movements want a management that's insulated or not creating value for the company. It always amuses me when people accuse us of trying to drive companies in the ground or make them non-competitive. I mean, the number one concern of labor unions, especially in the manufacturing sector, is trying to work with companies to make them even more competitive in the global economy. This is something that Andy Stern has gotten gospel around. So, a union member's best friend is a company that is managed for the long term, but also managed in a way that's healthy and sustainable. So, if one way to shake loose a board that's not doing their job, that's not providing enough oversight, or a management that's enriching themselves at the expense of the company and the employees, if one way to achieve that is say on pay or proxy access, we're going to use that tool to try and construct it in the right way.
Mark, they want to give long-term shareholders more power than short-term shareholders. You could do that, right? I mean, you could have what's called tenured voting, where if you hold the shares for 2 or 3 years, you get 10 votes per share, and if you hold them for less, you get 1 vote per share. Perfectly legal under Delaware law. Williams against Geyer says it's fine. It doesn't even have unical scrutiny to switch to that. Is that something your clients are looking to support?
Well, you keep trying to drive us apart, but I really decline. I agree. I think activists target companies that are poorly run. That's why their stock's down. That's why there's a profit opportunity in turning them around and getting the stock price back up. And I agree, companies that are run more efficiently and more profitably will improve things for all their constituencies, including labor. Companies not run well, they can't borrow, they don't have access to the capital markets as efficiently as better run companies and more profitable companies, have a hard time growing. I mean, activists want companies to grow. That means their stock price is going up. That's what we want. We're aligned.
Michael?
Well, I mean, you have to ask Dan the same question, which is, why not go the extra mile and ask for tenured voting?
I mean,
That's your issue. If you're really short-term, long-term, why isn't your core issue tenured voting?
There has been a big push in the labor movement to push tenured voting, cumulative voting through proposals. But I think it comes down to we need to get beyond just voting on bad board members and instead propose board members who are more independent and more responsive. That the fundamental for us, it's all about boards and proposals are good and targeting pay is good. But until we change that dynamic where boards can be overwhelmingly reelected without any challenge, and in some cases reelected just by voting for themselves if it's not a majority vote regime, we're going to keep having the same problems, whether it's outsized pay awards, the failure to manage risk by banks. So I think that's why you see so much focus on proxy access and so much pushback by the forces that want to preserve the status quo in terms of keeping boards insulated and free from those accountability moments.
We are out of time. One thing we try to do in this class is end. It's supposed to end at 6:20, so we're a few minutes over. Please join me in thanking the panel. Those who are staying for dinner, we're eating over at the Inn at Penn on the 3rd floor of the Richards Room.